Welcome to this session of ICAN Academy tutorial on final accounts. So in this lecture, I'll be examining the meaning of final accounts, definition of terms, format for the preparation of final account, then additional information, that is adjustments to final accounts. Then I will also solve questions from 8 years past exams. Final accounts of sole traders. By final accounts, we mean the statement of profit or loss, and other comprehensive income. Statement of changes in equity, and statement of financial position. These are to a sole trade business. To a manufacturing business, in addition to this, manufacturing account will be included. To a partnership business, in addition to all this, profits or loss appropriation account will be part of it. Definition of terms. Sole traders or sole proprietorship. This is a one-man business. That is a business that is owned and managed by one person. Any business that is owned and managed by a single person, such business is said to be a sole traders or a sole trade business or sole proprietorship. So, but our focus is the final accounts of a sole trader. So, number one is statement of profit or loss. Statement of profit or loss and other comprehensive income. This is the statement that shows the profit earned or losses incurred in the period. So that means this financial statement is prepared in order to ascertain the profits or losses of the business. So the major profit you may need to ascertain from this account is gross profit. This is the excess of revenue over cost of sales. Gross profit, excess of revenue over cost of sales. That is, revenue minus cost of sales, that will give you the gross profit. So if you want to prepare the final account of a sole trader, if you want to prepare the statement of profit or loss, the format will be, let me say, A Enterprises. The name of the entity is A Enterprises because it's a sole trade business. Then we have statement of profit or loss and other comprehensive income. For the year ended You put the year end. Let's assume it is 31st December 20XX. So, remember, I've told you the first profit to ascertain is the gross profit. I will say gross profit is revenue less cost of sales. What is revenue? That is the starting point. It means before you can calculate the gross profit, you must have known your revenue. Revenue is an income which arises from the ordinary activities of the entity. Income which arises from the ordinary activities of the business. Ordinary activities will mean the normal activities of the business, what the entity deals in. So income they generate from their principal activities. So that income is said to be the revenue. So if an entity is into buying and selling of goods, if they sell an asset, the profit from disposal of that non-current asset will not be recognized as revenue, because that profit is not from their principal business activity. That profit from sale of an asset, no, the business is not established in order to buy and sell an asset. They are into buying and selling of inventories of goods. Now, if they now sell asset, they sell their asset, I said that cannot be recognized as revenue because it is not from their principal activities. It is not from their principal activities. That does not originate from their principal activity. So examples of revenue include sales revenue. Sales revenue. That is an entity that deals in buying and selling of goods. The revenue from sale of goods will be recognized as revenue to such an entity. Then we may also have fee income. Fee income. A service, an entity that is engaging in provision of services and they charge fee, such as audit firm. So the fee they charge is a revenue to them. Then we may also have royalties income. Royalties. Where you give someone the right to use your properties, to make use of your assets, your resources, the remuneration payable to you as the landlord, the owners of that right, that legal right. Maybe it may be a copyright where you are an author of a book. So you give someone the right to sell your books, to market your book on your behalf. The person will be paying a remuneration to you. That remuneration payable to you is a revenue to you. That is royalty income. Income from investment. So an investment companies, income from investment. If the principal activities of the business is investment, an investment income, an investment company, so the income they received from their investment is a revenue to them. So that is why I said revenue is an income which arises from the ordinary activities of the entity. So it means if you want to prepare the statement of profit or loss, the starting point will be revenue. So you have your revenue. So that will be the first item. Then from this, you let's return inwards. Let's return inwards. So that is the next item to consider. Return inwards. So what do we mean by return inwards? Return inwards. Another words for return inwards is return on sales. Return on sales. After sales have been made, the customer return part of the goods you have sold to you. Remember that goods have been recorded as sales. It have formed part of your revenue. But when the customer return them back to you, that means you didn't sell them again. It is wrong to still have it as revenue when such goods have been returned to you. Therefore, the goods returned by customers to you is known as return inwards or return on sales. Therefore, return inwards, you have to subtract it from sales since it is no longer supposed to form part of your revenue. You subtract it because it is no longer sold out. It is not sold out again since they have been returned back to you by the customers. So you have the net revenue. Now, after your revenue, remember, I've told you the first profit you are certain is the gross profit. And I've told you that the gross profit is revenue less cost of sales. So when you subtract cost of sales from revenue, you get the gross profit. So what do we mean by cost of sales? Cost of, let me say, goods sold. This is the cost of the inventory that are sold out in the period. The cost of the inventory that are sold out during the period. They are direct cost. Cost of sales are direct cost of the items sold. So to ascertain the cost of sales, you start with the opening inventories. I've told you, you less your cost of sales, less cost of sales or cost of goods sold. And your cost of goods sold, to ascertain this, you start with the opening inventories. Opening inventories. What do we mean by opening inventories? Opening inventories are inventories in hand at the beginning of the trading period. Opening inventories are inventories in hand at the beginning of the trading period. Opening inventories. Now, if you have this in hand at the beginning of the trading period, this may not be enough for you to sell. So what will you do? You need to buy more. So we have purchases. Purchases. In accounting, purchases mean goods bought for resales. That means the primary reason for buying them is to resell them. Goods bought for resales. If you are into buying and selling of goods, if you buy motor vehicles, you know the motor vehicle is bought for business use, not for resales. So acquisition or purchase of motor vehicle, it is wrong to classify it as purchase because it is an asset to you, not you didn't buy it in order to resell. I've told you purchase means goods bought for resales. So if you record the purchases of an asset as part of your purchases for the period, the error committed is known as error of principle because the transaction has been recorded in wrong class of account. Even if that error is committed, your balance sheet will still balance because your purchase is having a debit balance. Then purchase of an asset, that asset where it is supposed to be recorded to is also having a debit balance. Your account will still balance, but it doesn't mean you have not committed an error. You have committed an error of principle. So where you have purchase, you add it to your opening inventories. You add purchases. Let me say add purchases. Remember, I've told you purchases are goods bought for resales. You have now buy more because this was in hand. You bought more of the items. Now, it is possible you may incur certain amount of expenses in bringing the goods bought to your store, to your warehouse. And that expense incurred in bringing it to your warehouse is called carriage inwards. Another word for carriage inwards is carriage on purchase. So it must form part of the purchase price of the item. Carriage inwards or carriage on purchase. They are the cost or expenses incurred in bringing the goods bought from the place of purchase to the firm warehouse. The expenses incurred in bringing the goods from the place of purchase to your warehouse is known as carriage inwards or carriage on purchase. Therefore, since it was incurred in bringing the goods bought, it must also form part of the purchase price of the item. That is why carriage inwards should always be added to the purchase. Now, after carriage inwards, you may less return outwards. Less return outwards. Now, the goods have been bought. The goods bought have now been taken to your warehouse, but you discover some of the goods bought are of wrong color. Return outwards, or return on purchase. Return on purchase or return outwards. Now, when you discover the goods are of wrong color or of wrong delivery, or they didn't meet your specification, what will you do? You return them back to the suppliers. Therefore, return outwards are the goods returned to the suppliers. Since these goods return it was part of the purchase you have made earlier. It was part of the purchase you have made. You have to subtract it from the purchase. I didn't buy this again since I've returned them. It is no longer part of my purchase. Therefore, return outwards should always be deducted from the purchase. I've told you that the return outwards is also called return on purchase. Then you have the net purchase of this. Then if you add this to your opening inventory, you get cost of goods available for sales. Cost of goods available for sale. Cost of goods available for sales. Then from this, if you have any closing inventories, what do you mean by closing inventories now? Notice number 11. Closing inventories are inventories in hand at the end of the trading period. That is closing inventories. I've told you these are the inventories in hand at the end of the trading period. They are the inventory that remain unsold. After you have acquired your inventory, you have all necessary inventory in place, you sell part of them. At the end of the period, the one that you have not sold, we refer to them as closing inventory. The one that are yet to be sold. It doesn't mean you will not sell them, but as at the end of the trading period, they have not been sold. That is why we refer to them as closing inventories. Now, remember the purchase you have before. These are the cost of goods available. This is what is available to you for sales. And your closing inventory is part of this. Then if you now subtract less closing inventories. So this is available for sales. If you now subtract the closing inventory, that means the remaining one will be the cost of goods sold. Cost of goods sold. The cost of goods sold will now be subtracted from the net revenue obtained above in order to arrive at the gross profit. Gross profit. Gross profit. Remember, I've told you gross profit is the excess of revenue over cost of sales. Now you've gotten the gross profit. Now, after gross profit, then you want to ascertain the next profit, the second profit. You are targeting another profit now. Number 12. Net profit. That is the second profit we are targeting after the first profit. The second profit is called net profit. As the name implies, net means minus. So, minus. If you subtract the profit after the deduction of all operating expenses, we refer to that profit as the net profit. Net profit is the total income or your gross profit less operating expenses. The gross profit less operating expenses will give us the net profit. But this your gross profit. You might still have other income that did not form part of our gross profit that have not been considered. You add them. You add, add other incomes. Add other incomes. Now, we said earlier that revenue is an income from the ordinary activities of the business. You might have other income that are not from ordinary activities. If your business is buying and selling of goods, You might also have a property you rented out. So you have rental income. Rental income. The income from the property you rented out. The properties is your personal properties. You rented them out. Then the investment income. Investment income, such as dividend received. Where the business invested in other business or businesses, then the income from that business must form part of your income. You add them to your gross profit. Then after this, you might also have discounts received, where you pay promptly. Discount received. This, you receive them from your suppliers. It's a rebate to you. The discount received is an income to the business. So it will be added. Decrease in allowance for receivables. Decrease in provision for bad or doubtful debts. So this will be added. So all these forms part of your income. All this income will be added. After summing up all this income, then you now less your expense. So you have the total income. Total income. After all this have been added to your gross profit. After this total income, you now less expenses. Less expenses. There are varieties of expenses that may be incurred by the business. So all the expenses, you might have salaries and wages, salaries and wages, salaries and wages, rent and rates. If you rented an apartment, you pay for rent. But if you are the owner, you receive rent. So the one you receive from your own property is rental income, rent received. But the one you paid, if you rented a property, you have to pay your landlord. The rent you pay to the landlord, that is the rent we have under expenses. Transport expense. Transport station expenses. Then office expenses. Stationery. So we have various carriage outwards. Carriage outwards an expense. Carriage inward will be added to purchase. Carriage outwards. Another word for carriage outwards is carriage on sales. Cost of transporting the goods to customers. That is an expense. Discount allowed. Discount allowed. Depreciation of non-current assets. Salesman commission. If the entity receives commission received is an income. You treat it as other income. So let me have other expenses. Other expenses. Any other expenses that I face to list here, you have them there. So all these expenses will be added. When you add the expenses, you now subtract the total of all those expenses from your total income. You subtract the total expenses from the total income, then you get the the net profit. So the net profit. So net profit. Before I consider the statement of financial position, I want to consider the adjustments to final accounts. That is how to deal with the items of additional information. Remember bad debts. Bad debts written off is part of the expenses. Treatment of additional information. Where these items are given in additional information, we want to explain how to deal with them. So the number one item I will examine is bad debts. Bad debts. What are bad debts? Bad debts are debts that may not be recovered. So we refer to them as irrecoverable debts. They are part of the receivables whose the person owing it has disappeared, and the entity may not be able to get that money back from that person. So we refer to them as bad debts. So in accounting, the additional information we normally give them a double entry treatment. So since it is bad, you know it is already part of your receivable, you have to reduce your receivable by that bad debts where it is in additional information. But where it is in the trial balance, that means it have already been deducted from the receivables. So you don't need to deduct it further from the receivables. But only where you have it in additional information, that is what I mean. So your bad debts now will need to be subtracted from the receivable, then you now treat it as an expenses. So you are giving it a double entry treatment. So debit bad debt expenses. That is, or you may say debit profit or loss and credit receivables. So that is, you are deducting these from your receivables. You are not charging it as an expense. You are writing it off in the statement of profit or loss. That is number one. Number two, depreciation. Depreciation is the allocation of a depreciable amount of an asset over its estimated useful life. Allocation of a depreciable amount of an asset over its estimated useful life. The depreciable amount of an asset is the cost of the asset. When we say depreciable amount, depreciable amount equals to cost minus salvage value or residual value. So depreciation is covered in IAS 16, property, plant and equipment. If you want to learn more about depreciation, go and watch my video on IAS 16. So the part not yet considered will be released soon. So number three. So how do you treat your depreciation? Depreciation, you charge it as an expense in the statement of profit or loss. You debit statement of profit or loss, profit or loss, and credit accumulated depreciation. The accumulated depreciation balance, the balance in accumulated depreciation will be used to reduce your tangible non-current asset in the statement of financial position. That is 2. Now, number 3 term I want you to bear in mind before I go into other items is periodicity concept. This is an accounting concept. Periodicity concept or interval concept. The reason why I want to explain this is that this will serve as a guide to other items of additional information I'm about to examine. So what do we mean by period? Period is referring to time. Interval. The periodicity concept opines that financial statements are prepared at a regular interval. It states that financial statements are prepared at a regular interval, usually a year. So if you want to prepare the financial statement, the accounting period will run from one period and it will end in another period. Now, let's assume this is the accounting period. This is accounting period. This is the starting date. Starting date. This line is the starting date. This is the ending date. End date. Ending date. This is where the accounting period ends. No, it may be, this start date may be January 1 to the end date may be December 31st. And it may be July 1 and June 30 of the following year. Or it may be April 1st of one year and to March 31st of the second year. So it depends on the accounting period. So accounting period, a period that is covered by the financial statements. That is the accounting period. A period covered by the financial statements. I want you to bear this in mind. Anything outside this date, that is previous period, previous accounting period. Anything that falls within this region, no, the accounting period starts from here. If it falls here, that means it relates to the previous accounting period. But if it falls here, that means it falls within the next accounting period. Please bear this in mind. It is this periodicity concept or interval concept that we highlight to be applied to other adjustments I'm about to look at. Number 4 item I'm going to look at is prepayment. Prepayment. Another word for prepayment, prepayment or payment in advance or prepaid expenses. Expenses. Or some might say underpaid. Underpaid expenses or expenses underpaid. Any of these terms, you might see them in exams. So what do you mean by prepayment? Where a service have not yet been rendered, but that service has been paid for. That service is said to be prepaid. You are making a payment for the future period that you have, in which the service for that period have not yet been enjoyed. You have not enjoyed the service. You have not made use of that service, but you are paying for it in advance. That is prepayment. That is payment in advance. Now, the question I want to ask you, does it relate to this accounting period? No. Of course, it is no. Which period does it relate to? Next accounting period. Since it does not relate to this period, it relates to next accounting period. That means it is not supposed to form part of this year financial statement. So that is why you have to exclude it from this year financial statement. That is why we have to, where it has been included in the expenses paid, you know the amount has been paid, you have to subtract it for that from that expenses. So you subtract it, you remove it from the expenses, now treat it as an asset, just like it is a receivable for the next period, since that amount, the service have not yet been enjoyed. So you are indebted to the person who made such payment. So since you are indebted, so it is a receivable. So it relates to the next period. Therefore, what is the double entry? You debit prepaid expenses, that is asset. You debit the asset, then you credit expenses to which it relates. Why crediting the expenses? You are subtracting it from the expenses. You are reducing the expenses by the amount prepaid. Please bear that in mind. Now, the next item I'm going to examine is accrued expenses. Accrued expenses. So, or owing, or accrued, or payment in arrears, or underpaid. Any of these terms may be used. So they all mean the same thing. Or outstanding. Outstanding. They all mean the same thing. Accrued. So now, what does this mean? A service have been enjoyed this time around. That is opposite of prepayment. A service have been enjoyed. You have enjoyed that service. The person have rendered that service for you, but you've not paid the person. That payment relates to this current period, but it has not yet been paid. So that is why we refer to that as an accrued expenses. Accrual is an amount due in respect of a service that have been enjoyed but not yet paid for. Amount due in respect of a service that have been enjoyed but not yet paid for. That service have been enjoyed, but you've not paid for that service. Now the question I want to ask you is, does it relate to the accounting period? Does it relate to the accounting period? Yes, it relates to it. Has it been included in the money in the trial balance? No. Does it relate to the accounting period? Yes. If it relates to the accounting period, that means it has to form part of the amount that will be charged in the statement of profit or loss. But since it hasn't been paid for, that is why it has not been included in the amount given in the trial balance. And that is the reason the examiner is giving you that item by the way of notes to the question, by the way of additional information. Please bear that in mind. Now, since it relates to your accounting period, you will need to add it to the expenses to which it relates. You want to charge it to the statement of profit or loss. Of course, that expense have not been paid for. Since it hasn't been paid for, that means it remains a liability to you. So what is the double entry? Debit the expenses, profit or loss, and credit liability, statement of financial position. So debit expenses, that is statement of profit or loss. The expenses you have in statement of profit or loss, credit accrued expenses. Accrued expenses will be shown as liabilities in statement of financial position. So that is the double entry required for the expenses accrued, expenses outstanding, payments in arrears, owing or accrued expenses. Bear that in mind. Now, number 6 items I'm about to look at is allowance for receivables or provision for bad or doubtful debts. Allowance for receivables. Now, allowance for receivables, provision. This is an estimate. Allowance for bad debts, allowance for receivable is an estimate. This hasn't actually become bad. It hasn't become bad, but based on your past knowledge, you want to make provision for that in line with the prudency concept or the convention of conservatism. So, but I will leave that for a separate video. I will examine accounting concepts and conventions in a separate video. That is why I won't say much about that. Allowance for receivable is an estimate amount of receivables that may not be recovered. An estimate amount of receivables that may not be recovered. That is known as allowance for receivables. Now, the allowance for receivables needs to be considered as a separate topic. But I just want to give you this clue. An increase in allowance for receivables should be charged as an expense. Bear this in mind. How do you know where it is an increase? Where the figure in the additional information is greater than the figures you are given in the trial balance. That means it is an increase. Of course, if you don't have allowance for receivable in the trial balance before, That means the amount there is zero since you don't have any allowance for receivable previously, but you only have it in additional information. That means it increases from zero to the current amount. That means you still have it as an increase. Increase in allowance for receivable should be charged as an expense in the statement of profit or loss. Please bear that in mind. But where the figure given in additional information is lower than the figure given in the trial balance, that means you have a decrease in allowance for receivables. Therefore, a decrease in allowance for receivables should be treated as an income in the statement of profit or loss. But the new allowance for receivables you have in additional information is what will be deducted from receivables in the statement of financial position. Increase is an expense. Increase, expense. Decrease in allowance for receivable is an income. Why new balance? New balance. By new balance we mean the balance you have in additional information should be deducted from receivable in this statement of financial position. ATS1 March 2025 basic accounting question number 6. Yafiu Enterprises is a dealer in special traditional medicine. He imports similar medicines from abroad. Whenever there is shortage in the local market, the trial balance of the entity as at December 31st, 2021 is detailed below. We have the debit and the credit side. And the amount is in 1,000 Ghana cedis. Investment income 550. Purchases and sales 7,970 and 40,250. Receivables and payables 4,850 and 2,380. Inventories of finished goods on 1st of January 2021 1,140. Motor vehicles 3,800. Electricity expenses 325. Land and building cost of land is 2,000 Ghana cedis. We have 14,000. Office equipment 4,550. Drawings 1,825. Returns 930 and 485. We have carriage inwards 300. Administrative expenses 980. Salaries and wages 3,650. Vehicle running expenses 320. Allowance for irrecoverable debts 450. Investments 8,500. Bank and cash balances 4,380. Selling expenses 4,785. Furniture and fittings 5,000. Capital 13,455. Allowance for depreciation include office equipment 2,250. Motor vehicles 2,270. Land and building 5,500. Discount allowed 285. Total of both the debit and credit side is 67,590. The following additional information is relevant. 1. The inventories at 31st December 2021 were recorded at 950,000 Ghana cedis. Note 2. The enterprise depreciates its assets on cost as follows. Assets and the percentage. We have building 4%, motor vehicles 20%, then office equipment 15%, furniture and fittings 10%. Note 3. Administrative expenses include rent of 250,000 Ghana cedis. This represents rent for the period of July 1st, 2021 to May 31st, 2021. Note 4. The enterprise is to make allowance of 345,000 Ghana cedis in respect of personal income tax for 2021 accounting year. Note 5. Amount owing in respect of electricity and vehicle running expenses are 55,000 Ghana cedis and 75,000 Ghana cedis respectively. Note 6. Allowance for irrecoverable debts is 500,000 Ghana cedis. You are required to prepare 1. Statement of profit or loss for the year ended December 31st, 2021. 2. A statement of financial position as at that date. The name of the entity is your fuel enterprise. We have solution. The A part, you have your fuel. Your fuel enterprise. You have to prepare a statement of profit or loss. Statement of profit or loss for the year ended December 31st, 2021. And the amount is in 1,000 Ghana cedis. The first item will be revenue. Revenue. Now, if you go through the trial balance, you have your purchases and sales. The purchase is 7,970, while sales is 4,250. So the 4,250, which is sales, is your revenue. 40,250. Then from the revenue, you deduct the return inwards. If you go through the trial balance, you see returns there. Returns of 930. This 930 is return inwards, and 485 is return outwards. Return outwards will be deducted from purchase when calculating cost of sales, while return inwards will be deducted from sales. And return inwards is also called returns on sales. So when goods are sold, the one returned by customers after sales have been made, since it were returned, that means it is no longer part of the sales being made. So that is why we less return inwards. And return inwards amounted to 930. If you deduct 930 from 4,250, 4,250 minus 930, then you have 39,320. From this, you less cost of sales. No revenue. Less cost of sales will give us the gross profit. So you want to calculate the gross profit, so you less cost of sales. The cost of sales, and to calculate the cost of sales, you have the opening inventories. Opening inventories. Now, let's go through the trial balance. How much is our opening inventories? In the trial balance, you have inventories of finished goods, 1,140. Inventories of finished goods, that is inventory as at 1st of January 2021. You know, 1st of January 2021 is the beginning of the accounting period. So the inventory at the beginning of the accounting period is known as the opening inventory. So we have that as 1,140. So 1,140. Then you have purchase, if any. Purchases. Our purchase. Now, if you go through the travel, let me add Ghana cedis here. So, in the trial balance, you have the purchase there. We have purchases and sales of 7,970. This is purchase, while this is sales. So, the purchase we are looking for is 7,970. And the purchase will be added to the opening inventory, 7970. You add carriage invoice, if any. You have carriage invoice of 300. Another word for carriage invoice is carriage on purchase. The cost incurred in transporting the goods bought from the place of purchase to the firm warehouse. So the carriage invoice will therefore form part of the purchase price of the item. So we add carriage invoice. Add carriage invoice. Our carriage invoice amounted to 300,000 Ghana cedis. 7970 plus 300, and that is total 8,270. After this, we check if there is any return outwards. Another word for return outwards is return on purchase. We have returns. The returns at the debit side of the trial balance is return inwards, while the one at the credit side of the trial balance is return outwards. So we have return outwards of 485. Return outwards is the amount of goods returned to the suppliers. Goods may be returned to the suppliers due to wrong color, wrong delivery, spoilage, and so on. So when part of the goods bought, after taking the goods to your warehouse, you discover that they are not good or they didn't meet your specification. You have to return them back to the supplier since such good doesn't meet your specification. So since they have been returned, that means that goods return is no longer part of the goods bought. You have to remove them from the goods bought. So let's return outwards. We have return outwards of 485,000 Ghana cedis. So if you deduct the goods returned of 485, so you'll be left with 7785. 7785. If you now add this to your opening inventories of 1140, then you arrive at cost of goods available for sales of 8925. This is cost of goods available for sales. Cost of goods available for sales. Now from this, you deduct your closing inventories. If you go through the note 1, you have the inventories at December 31st, 2021 were recorded at 950,000 Ghana cedis. December 31st is the year end. So the inventory in hand at the end of the year, or inventories in hand at the end of the accounting period, are said to be the closing inventories. That means after those inventory the entity have been sold, the one that remain unsold, the one that are still in hands that are not yet sold at the year end are said to be the closing inventory. So we have the closing inventories of 950,000. So the closing inventory will be deducted from the cost of goods available for sales in order to arrive at the cost of goods sold. So we less closing inventories. We have closing inventories of 950. That is from the note 1. So if you subtract 950, then you have 7975. That is cost of goods sold. We have cost of goods sold of 7975. If you subtract cost of goods sold from the revenue of 39,320, then you arrive at the gross profit. We have gross profit of 31,345. That is the gross profit. Then after this gross profit, you go through your trial balance in order to ascertain if there are any other income that have not yet been recorded. So other income might include the rental income, investment income or dividend received or receivable, interest income, and or finance income, then discount received, decrease in allowance for receivables. So if you have any other income, then it has to be added to the gross profit. If you go through the trial balance, you have investment income of 550. Investment income will be added to the gross profit. So we have investment income of 550. Aside the investment income, let's run our eyes through the trial balance in order to ascertain if there are any other income not yet considered. So I can't say any income. Then look at allowance for irrecoverable debts, and we have the allowance for irrecoverable debts of 450. Now, if you compare it with what you have in the note C, the last note in the question, you have allowance for irrecoverable debts is 500. That means the old allowance was 450 and the new one is 500. So that means we have an increase in allowance for receivables. An increase in allowance for receivables is an expense, but if it is a decrease, you treat it as an income. You have a decrease in allowance for receivable if the one in additional information is lower than the one in the trial balance. But remember, the amount you have in additional information number 6 is 500, and what you have in the trial balance is 450. The one in additional information is greater than the one you have in the trial balance. So in that case, you have an increase in allowance for receivable. An increase is an expense. So if you now add this 550 to 31,345, so you have the total income of 31,895. So now from this income, you less the expenses. Less expenses. What are the expenses given in the question? But before we go through the trial balance, I will always advise you always go through your additional information in order to ascertain those expenses that will require adjustments in the trial balance. So that is, those figures in the trial balance will need to be adjusted in the statement of profit or loss. 2, you have the enterprise depreciates its assets on cost as follows, where depreciation is calculated on cost. That means the method of depreciation used is a straight line method. Just apply the rate on the cost of the asset directly. I want you to note that depreciation should be expensed. The depreciation chart for the year, the one given in the additional information, and the depreciation chart for the year, and the depreciation chart for the year should be the amount that will be expensed in the period. But the accumulated depreciation is what will be deducted from the cost of the asset in order to arrive at the carrying amount, that is the net book value of the asset, in the statement of financial position. To get the accumulated depreciation that will be deducted from the cost of the asset to arrive at the carrying amount, you have the depreciation previously given in the trial balance plus the depreciation chart for the year. Accumulated means up to date. You accumulate it up to date. To accumulate your depreciation up to date, you have the depreciation given in the trial balance plus the depreciation chart for the year. I've told you this depreciation chart, these are the depreciation chart for the year. So we want to calculate on building now. So let's calculate the depreciation. We have depreciation on building 4%, motor vehicle 20%, office equipment 15%, furniture and fittings 10%. Now let's calculate those depreciation accordingly. So depreciation. Depreciation on, we have building. All this information are obtained from note 1. The building 4%. Remember, you have to use cost. Then after building, we have motor vehicles, and that is 20% from note 1. Then we have office equipment, and that is 15% from note 1. Then furniture and fittings, and that is 10% from note 1. Remember, you have to depreciate. You calculate your depreciation on the cost of the asset. Now let's go through the trial balance in order to ascertain the cost of these assets. Motor vehicles 3,800. That is the cost of motor vehicles, 3,800. Then we have land and building. Cost of land 2,000. If land and building is 14,000 and cost of land is 2,000, That means building will be 12,000. Cost of building will be 12,000. We don't use to depreciate land. That is why we remove land. To get this 12,000, we have 14K minus 2K. 14,000 minus 2,000. That is how we got this to 12,000. So bear that in mind. The office equipment cost is 4,550. Office equipment 4,550. The cost of furniture and fittings is 5,000. So the depreciation will be calculated on the cost of furniture and fittings of 5,000. So we have 5,000 for furniture and fittings. Then if you calculate, you apply the rate on the cost for building, 4% of 12,000, that gives us 480. 480, that is for building. For motor vehicles, 20% of 3,800. 20% of that, it gives us 760. 760. For office equipment, 15% of 4,550. That gives us, let me just say 683 or 682.5. Then 10% of 5,000, that is 500. So these are the depreciation charge in the year. So that means the total depreciation charge in the year, if you add it. The depreciation is total 2422.5. That is the total depreciation charge in the year. Now, aside that depreciation, now let's go through the note. Note 3. Administrative expenses include rent of 250,000. This represents rent for the period of July 2021 to May 31st, 2022. So you were told the administrative expenses include rent of 250,000. Remember, rent is part of administrative expenses. That means that has been treated normally. But the normal accounting period, the accounting period using, the accounting concept using the preparation of the statement of profit or loss is known as the periodicity concept. Periodicity concept or interval concept. The periodicity concept or interval concept states that the financial statements are prepared at a regular interval, usually a year. Now, if you look at this question, the accounting period of this entity runs from January 2021 to December 31st, 2021. The accounting period of this entity is from 1st of January 2021 to December 31st, 2021. That means anything outside that period will not be included in the statement of profit or loss for that period. Now, look at this. Rent. You were told rent for the period of July 2021 to May 31st, 2022. So that means July 2021, August 21, September, October, November, December is still part of the accounting period. That is 6 months. But January 2022, February 2022, March, April, May. That is 5 months. January, February, March, April, May. That rent of 5 months is not part of the rent that is meant for the current accounting period. You know, the accounting year end is December 31st, 2021. So it means this rent has been prepaid. It has been paid in advance. How many months is this rent? From July 1 to May 31st, 2022, July 2021, July, August, September, October, November, December, January, February, March, April, May. It shows that from July 1st, 2021 to May 31st, 2022, that is 11 months. But we said of these 11 months, rent for January 22, February, March, April, May, 5 months is not supposed to be included in 2021 because that is for rent. That rent is for 2022. So the Administrative expenses, now you have to remove rent of that 5 months which have been prepaid. You have to remove it. It means it has been prepaid. Remember, another word for prepayment is payment in advance or overpayments. The payments in advance have to be removed, have to be excluded from the rent or administrative expenses that is due for 2021 accounting year. So you calculate 5 over 11 months times 250,000. You remove it from administrative expenses. Our administrative expenses amounted to 980. So we have administrative expenses, and that amounted to 980. From our administrative expenses, we less rent prepaid. We said rent for the period of January 1st to May 31st, 2022, we said that have been prepaid, which is 5 months. And the rent for the period, for 11 months period is given, times 250,000. So that gives us 250,000 times 5 divided by 11 months. That gives us 113.64. If you subtract that from the administrative expenses of 980, then you'll be left with a balance of 866.36. 866.36. Now, back to the footnote, back to the additional information. We have done with note 3, which is for administrative expenses. Then note 4, the enterprise is to make allowance of 345,000 Ghana cedis in respect of personal income tax for 2021 accounting year. So that is the allowance that is to be made for personal income tax. So we'll leave that for now. Now, note 5, amount owing in respect of electricity and vehicle running expenses are 55,000 and 75,000 respectively. Then this sum will be added to electricity, and this will be added to vehicle running expenses given in the trial balance. Owing, outstanding, accrued expenses or accruals or underpayments are the same. When a service has been enjoyed, when a service has been rendered, and that service have not yet been paid for, remember that sum relates to 2021. It is supposed to be paid in 2021, but it hasn't been paid. Since it relates to 2021, it will therefore form part of the expense for 2021. So we will add this to this one to electricity and this one to vehicle running expenses. Electricity. The amount paid in respect of electricity is 325. That is the amount paid. We add amount owing. Add owing. The one that have not been paid, since it relates to that period, it will be added. So we have 55. If you add the 55 to 325, the 55,000 owing is in the note 5 in additional information. So we have 380. 380. After that, we have vehicle running. Vehicle running expenses. Vehicle running expenses. The vehicle running expenses is given to be 320 in the trial balance. So the 320 given in the trial balance, you add the amount owing. Add owing. The amount owing, that is same note 5 in additional information, that is 75,000. If you add the 75 to this, you'll be having 395. 395. No 6. Allowance for irrecoverable debts is 500,000. So the 500,000 is the amount given as irrecoverable debt in the additional information. But if you go through the trial balance, you have allowance for irrecoverable debts of 450. The 450 is the amount given as an allowance for irrecoverable debts. The one in the additional information exceeds the amount given in the trial balance. Since the footnote, the one given in additional information, exceeds the one given in the trial balance, that means we have an increase in allowance for irrecoverable debts. An increase is an expense. So we have increase in allowance for irrecoverable debts. The 500,000 given in the note minus 450 given in the trial balance, you have the difference of 50,000. That is the amount of increase for the period. And I've told you that the increase in allowance for irrecoverable debts should be charged as an expense in the statement of profit or loss. Now let's go through the trial balance. We have dealt with all the expenses in the additional information apart from the tasks that have not been considered. Now, what are those expenses that have not been used? So, this is an asset, this is liabilities. This have been used. This is an asset. Electricity expenses have been used. Land and building. Office equipment, those one are assets. Returns have been used. Carriage invoice have been used. Administrative expenses have equally been used. Salaries and wages, 3,650, that have not been used. So now let's recognize that. So we have salaries and wages. Salaries and wages. We have salaries and wages of 3,650. 3,650. Then, aside the salaries and wages, which other expenses do we have? So we have economic expenses that have been used. Allowance for recoverable debt have been used. Investments and asset. Bank and cash balance and asset. Selling expenses 4785 that have not been used. So we want to record that selling expenses. So selling expenses. Selling expenses. That amounted to 4785. Furniture and fittings an asset. Capital, that is equity. Allowance for depreciation, these are depreciation, and this one will be used in the statement of financial position. We have discount allowed of 285. That is the only expenses that have not yet been recorded. So we have discount allowed, discount allowed, 285. So we now sum up all our expenses. What are certain the net profit for the period? Our expenses, we have sum up all the depreciation, and that is 22.5 plus 866.36 plus 380 plus 395 plus 50 plus 3650 plus 4785 plus 285. Our expenses is totaled 1 to 12,833.86. 12,833.86. There is point here, 86. If you now subtract the expenses, if you subtract it from the total income, remember our total income is 31895. Now subtract the total expenses from the total income minus 31895. We have the profit before tax of 19,061, 19,061.14. That is the profit before tax. Profit before tax. After this, we want to consider the tax expense or tax provisions. And this is given in the note in additional information. Note 4, you were told the enterprise is to make allowance of 345,000 in respect of personal income tax for 2021 accounting year. So provision of 345,000 were made during the period for personal income tax that will be deducted in order to arrive at profit after tax or profit for the year. So we have the tax expense or tax provision of 345. If you subtract the 345, then you'll be left with 18,716.14. That is the profit for the year. So this is all about the statement of profit or loss. The next requirement, that is the B part of the question, you want to prepare the statement of financial position. In the B part of the question, you have to prepare the statement of financial position. So we have your field enterprise. Statement of financial position. Statement of financial position. Position as at December 31st, 2021. So, to prepare the statement of financial position, the starting point is assets. You start with your assets. Of course, the assets to start with will be the tangible non-current assets. So you have the carrying amount, carrying amount or carrying value, then accumulated depreciation, and the cost of the asset. And the amount is in 1,000 Ghana cedis. So the first asset to start with is our non-current assets. Non-current assets. The non-current assets to start with should be the property, plant, and equipment that is made in accordance with the provisions in IAS 16. IAS 16 deals with the property, plant, and equipment. If you run your eyes through the trial balance, receivables is current assets, Then you have motor vehicle 3,800, land and building 14,000, office equipment 4,550. Now, let's record those three assets first at their cost. The first one is motor vehicles. Motor vehicles. And the cost of the motor vehicles is 3,800. Then that of the land and building. All these figures were lifted from the trial balance. We have 14,000. So that is the amount given in the trial balance. Then we have office equipment. Office equipment. The amount given in trial balance is 4,550. Then we also have furnitures. Furnitures of 5,000 is equally given in the trial balance. Furnitures, 5,000. Furnitures, 5,000. These are the cost of the asset as per the trial balance. Then, if you go through the same trial balance, you will see the accumulated depreciation. The accumulated depreciation in respect of office equipment is 2,250. This 2,250 given in the trial balance is the depreciation charge for the prior year. To get the accumulated depreciation, two things have to be added. Accumulated depreciation that will be in the statement of financial position, that will be prior year depreciation plus the current year depreciation. The prior year depreciation is the amount given in the trial balance. In respect of office equipment, we have 2,250. Now, the current year depreciation is the amount you have charged as an expense in the statement of profit or loss. Then for office equipment, depreciation of 682.5 was charged. 682.5, if you add the figure given in the trial balance to that 682.5, then you get the accumulated depreciation that will be in the statement of financial position. That is, office equipment, the accumulated depreciation 2250 plus 682.5 given 682.5 we've obtained in the statement of profit or loss under expenses. If you add the two together, 2250 plus 682.5, that gives us 29. That is office equipment. Accumulated depreciation is 32.5. The same thing will be done to other classes of assets. So, but in the same trial balance, you have accumulated depreciation for motor vehicles of 2,270. 2,270 plus how much was charged as an expense for motor vehicles? 760 was charged. If you add the 760 to that, to this 2270 plus 760, then you get the accumulated depreciation of 30. So that is for motor vehicles, 3,030. Then, as after motor vehicles, you have land and building. The accumulated depreciation in respect of land and building is 5,500. That is the amount given in the trial balance. 5,500 plus how much was given in respect of land and building in the statement of profit or loss. Remember depreciation of building, and that was 480. If you add the 480 to 5,500, you get 5,980. So that is the amount of the accumulated depreciation that will be used in the statement of financial position. 5,980. 980. Now, we are left with furniture. No depreciation is given in the trial balance in respect of furniture. But in our statement of profit or loss, we got 500 as the amount of depreciation on furniture. So that 500 will be charged against the furniture in the statement of financial position. So we have 500. So the carrying value of furniture will be 4,500. The 4,500 will be cost minus accumulated depreciation. 3,800 minus 3,030, that gives us 770. That is the carrying value of motor vehicles. For land and building, we have 14,000 minus 5,980, and that gives us 8,020. 8020. Then for office equipment, 4,550 minus 2,932.5, that gives us 1617.5. So what is the accumulated depreciation? So let's sum up the carrying value. Sorry, what is the carrying value? 45 plus 1617.5 plus 8020 plus 770. Then you have 14,907.5. So for the accumulated depreciation, 3030 plus 5,980 plus 2,932.5 plus 500. So we have 12,442.5. Then 3,800 plus 14,000 plus 4,550 plus 5,000. This gives us 27,350. After non-current assets, the next asset should be current. So we want to consider the current asset. Current assets. The first current asset to consider should be inventories. That is the closing inventories. Inventories at the year end. The closing inventory is given in the additional information number 1. You were told the inventories at December 31st, 2021 were recorded at 950,000. So this 950,000 will be shown as the current asset. Current asset. 950,000. Then after inventories, we have trade receivables. We have receivables. Receivables is the amount given in the trial balance. In respect of receivables, because in the trial balance you have receivables and payables. The receivables is 4850, while the 2380, that is payables. So our receivable is 4850. Then if you look at the note, the last note, let me first of all record that our receivable is 4850. Now less allowance for irrecoverable debt. The one given additional information is what should always be used. The allowance for irrecoverable debts, the last note, we were told allowance for irrecoverable debts is 500,000 Ghana cedis. So that is the amount that will be deducted from the receivables. So we deduct the 500. So you'll be left with 4350. Lest I forget, we have investments of 8,500 in the trial balance. The investment is part of the non-current asset. Therefore, the 8,500 should form part of our non-current asset. So let me add that. So we have investment. $8,500. So if you add it to 14,907.5, so that means our non-current assets is totaled 23,407.5. 407.5. Then we are on current assets. Let's go through the trial balance in order to ascertain if there are any current assets that have not been used. So we've used the receivables. So inventory is the opening. This is non-current. This is expenses, non-current drawings, returns, carrying your administrative salaries, vehicle allowance, investment, bank and cash balances. That is current asset, 4,380. So that should form part of our current asset. Bank and cash balances. Bank and cash balances, and that amounted to 4,380. Then, if you look at our expense, the expenses we have charged earlier, we have rent prepaid. The rent prepaid, we have rent prepaid of less rent prepaid of 113.64. The prepayment is part of current asset, so we should include that. We need to include that as part of our current asset. So we have rent prepaid. This have been shown as an expense where we calculated 5/11 or 250,000. And that gave us 113.64. 113.64. So that it should be treated as part of our as part of our current asset. Then aside that, let's go through the trial balance. Do we still have any other item that need to form part of our current asset? The furniture is non-current, capital, all these have the no current asset. Then the additional information, inventory have been used, depreciation have been considered, administrative expenses that have been considered. So there are no other current assets that needs to be used. So we sum up our current assets in order to get the total of our current asset. So our current asset now, we have 950 plus 4350 plus 4380 plus 113.64. Then we have 9793.64. 9793.64. Then if you add that to the non-current asset of 23,407.5, total assets amounted to 33,201.14. That is the total assets. Total assets. After total assets, the next section is equity and liabilities. So equity and liabilities. The starting point is our equities. So you are starting with the equity. Now, back to the trial balance. In our trial balance, we have the capital. Capital of 13,455. That is the capital we have in the trial balance. 13,455. That is the capital, and our capital is part of the owner's equity. So we have capital, which is 13,455. We now add net profit to this. Add net profit. Now back to the to the statement of profit or loss, where our net profit was calculated, and we got the profit for the year of 18,716.14. 18,716.14. So that will be added as our net profit. 18,716.14. So we have 13,455 plus 18,716.14. So that gives us 32,171.14. So we let's drawings. Drawings is anything taken out of the business for personal use. Drawings amounted to 1825. 1825. If you subtract drawings, 32,171.14 minus 1825, we have 30,346.14. 346.14. That is the owner's equity. Then we have current liabilities. Current liabilities. Our current liabilities include payables. In the trial balance, we have receivables and payables. Receivables and payables. This is receivables, while this is payables. 2,380. 2,380. Payables, 2,380. Apart from the payables in the trial balance, do we have any other item of current liabilities? So let's go through. So there are no other items of current liabilities in the trial balance. In the additional information, the first item is inventory. The second one is depreciation. The third one, administrative expenses, include rent of. So we've included the rent paid in advance under current assets. Note for the enterprise is to make allowance of 345,000 in respect of personal income tax. So that provision for personal income tax 345,000 will be shown as current liabilities. So now let's have provision for personal income tax. Provision for personal income tax of 345,000, and that is obtained from the additional information number 4. Then note 5. Amount owing in respect of electricity, vehicle running expenses are 55,000 and 75,000. These owings will form part of the current liabilities. Allowance for irrecoverable debts, these have been deducted from receivables under current assets. So we are left with owing 55,000 and 75,000, which will be shown as part of our current liability in the statement of financial position. So we have owings. We have 55,000. 55,000 plus 75,000. So 55,000 plus 75,000, that is total 130,000. So let's sum up our current liabilities. 130,000 plus 345,000 plus 2,380. Our current liabilities is total 2855. 2855. You now add the liabilities to your equity, and our equity is 30,346.14. So we have 33,201.14. 33,201.14. That is the total equity and liabilities. Total equity and liabilities. So the total equity and liabilities is the same as the total asset, 33,201.14. Both agrees. So this marked the end of the solution to the question. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ACCA.